So, basically, what is the S&P 500?
The S&P 500 is a list of about 500 large companies in the United States. It includes many famous businesses like Apple, Microsoft, Amazon, Alphabet, Google, Meta, and many others. The letters S&P stand for Standard & Poor's, which is the company connected to creating the index, and the number 500 refers to the approximate number of companies included in the list. The S&P 500 is often used to help measure how large American companies are performing overall. For example, if many of the companies in the S&P 500 perform well and become more valuable, the S&P 500 usually goes up. But if many large companies are struggling or losing value, the S&P 500 can go down too. That is why many people watch the S&P 500 closely. It is often seen as one of the most important indicators of the American stock market. Many index funds also follow the S&P 500. That means the fund tries to copy the overall performance of those companies as closely as possible. So basically, the S&P 500 is like a large scoreboard that helps show how about 500 major American companies are performing together over time.
So, basically, what is an index fund?
An index fund is a type of investment that holds many companies together in one big group. Instead of buying stock from only one company, an index fund spreads the money across many companies at the same time. For example, an index fund might include companies like Apple, Microsoft, Amazon, Alphabet, Google, and hundreds of other large businesses. So instead of trying to guess which single company will become successful later, people buy a small piece of many companies together. That is one reason many people see index funds as simpler and less stressful than picking individual stocks. An index fund usually follows something called an index. An index is basically a list that tracks how a group of companies is performing. One famous example is the S&P 500. The S&P 500 tracks about 500 large companies in the United States. If many of those companies perform well, the index usually goes up too. And the index fund tries to follow that movement as closely as possible. So basically, an index fund is like buying a big basket of many companies together, instead of trying to choose only one company by yourself. That is why many people use index funds as a simple way to invest in the overall stock market.
So, basically, why do people like index funds?
Many people like index funds for three main reasons: simplicity, diversification, and relatively low costs. One reason is simplicity. Instead of researching hundreds of different companies, people can buy one fund that already includes many companies together. For example, an index fund may already contain companies like Apple, Microsoft, Amazon, Google, and many others. That means people do not need to guess which single company might become successful later. The investment is spread across many businesses at the same time. Many people also like index funds because they can feel less stressful than constantly buying and selling individual stocks. Some people do not want to spend hours studying the stock market every day. They simply want long-term exposure to many large companies together. Another reason is relatively low cost. Many index funds are relatively low-cost investments. Because the fund simply follows an index, instead of trying to actively pick winning stocks, management costs are often lower than some other investment funds. Over long periods of time, lower costs can make a meaningful difference to overall investment returns. A third reason is diversification. Diversification means the money is spread across many companies instead of depending on only one company. For example, if someone invests only in one company and that company performs badly, the investment could lose a lot of value. But with an index fund, many companies are combined together, so one company usually does not control the entire investment alone. Many people also like index funds because they automatically follow the performance of large parts of the market over time. As many businesses grow, the index fund may grow as well. However, index funds are still investments, which means they can still go down in value too. If the overall market falls, many index funds may fall as well. So basically, many people like index funds because they are a simpler way to invest in many companies together instead of trying to predict which single company will win in the future. They also offer diversification, are often relatively low cost, and allow people to participate in the long-term growth of many businesses at the same time.
So, basically, are index funds risk-free?
No, index funds are not risk-free. Many people think index funds feel safer because they include many companies together, instead of only one company. But index funds are still connected to the stock market, and the stock market can still go down. Many people still consider index funds less risky than investing in a single company. That is because the investment is spread across many businesses instead of depending on the success of only one company. For example, if large companies across the economy begin losing value, many index funds may fall too. That means people can still lose money, especially in the short term. For example, during major financial crises, many index funds dropped significantly because the overall market was falling. So even though index funds are often considered simpler and more diversified, they are still investments with real risk. Another important thing is this: an index fund does not guarantee profits. The value can go up, but it can also go down. Some years may perform very well. Other years may perform very badly. That is why many people who invest in index funds usually think long-term. They often expect short-term ups and downs along the way. Every investment involves some level of risk. So basically, index funds are not free money or guaranteed money. They are simply a way to invest in many companies together, instead of relying on only one company alone. While they may reduce some risks through diversification, they cannot eliminate risk completely.
So basically, what is a stock?
A stock is a small piece of ownership in a company. When someone buys a stock, they are buying a tiny part of that business. For example, a person might buy stock in companies like Apple, Microsoft, Amazon, or Google. Of course, one stock usually represents only a very small part of a very large company, but it is still a piece of ownership. Because of that, stocks are often called shares. A share is simply a share of ownership in a company. If the company becomes more valuable over time, the stock may become more valuable too. That is one reason why many people invest in stocks. Some companies may also share part of their profits with investors through payments called dividends. Dividends are not guaranteed, and not every company pays them, but they are another way investors may potentially earn money from owning stocks. For example, imagine a company grows, sells more products, earns more money, and becomes more successful. Many investors may then want to own part of that company. As more people want to buy the stock price may rise. However, stocks can also go down in value. If a company performs poorly, loses customers, or earns less money, the stock price may fall. That means investors can make money, but they can also lose money. Stocks are usually bought and sold through stock markets. These markets allow millions of investors to buy and sell shares of companies every day. Some of the world's largest companies have stocks that are traded on stock markets. So basically, a stock is a small piece of ownership in a company. People buy stocks because they hope the company will become more valuable in the future. Some investors may also receive dividends from certain companies, but stocks can go up or down in value over time, which means investing in stocks can involve both potential rewards and potential risks.